Your business made $30,000. Your tax return shows $2,000. That cap can stop your approval. Not because your business failed, because mortgages follow documented income. And the bank statement option surprises most owners. So stay with me. Here are the four loan options you have. Path number one is the tax returns. This is the traditional route. The lender reviews your filed income. Personal or business returns may be required. Many files use 2 years. However, some programs may allow 1 year of tax returns. Now, when we look at heavy write offs, this can reduce the income used for qualifying. That is where buying power can drop fast. Most owners plan around taxes. Now, that is extremely smart. Now, a tax saving strategy can create a mortgage concern. If you plan to buy within the next 12 months, review mortgage income before filing. Do not wait until the return is already done. At that point, your options may be reduced. Path number two, profit and loss. Some programs may review a CPA prepared profit and loss statement. Now that can help when today's business activities is stronger than the file returns actually show. Now, the numbers must connect to real cash flow. The file must support itself. Path number three is 1099 income. This can fit contractors paid by Form 1099. Some programs review 1 or 2 years of these forms. Then they apply an expense factor. The remaining amount becomes your qualifying income. Now, this can help when 1099 income gives a clearer and cleaner view than full tax returns. Now, the work type matters. If you're a consultant, a driver, a realtor, and a contractor may not receive the same expense factor. Path number four is bank statements. This is the option many business owners may miss. The lender reviews all your deposits over 12 to 24 months. Then an expense factor is applied. For many businesses, 30 to 50% may be deducted first. Some files may be lower, and then some files may be higher. It depends on the type of business and the account type, your deposit patterns, and loan program. Here is the simple math. If deposits average about $20,000 and 30% is deducted, that means you have $14,000 that may remain. That can look very different from a tax return only showing $2,000 monthly. That is why when you have a bank saying no, that does not end your conversation. But bank statements also need to be clean business records. Personal expenses need explanations. Transfers need a paper trail. And any large deposits you have, we need to see where it came from. Now, overdrafts can weaken the story. However, clean records make reviews that much easier. Alternative documentation is not magic. Down payment may be higher. Rates may be higher. They're priced differently. What kind of reserves are you going to need? We're also going to review your credit, your debt, your assets, and what type of property you are going to be investing in. The whole file must support the income path. That is why strategy starts before the application, not after the decline. We look at your tax returns, your profit and loss, your 1099s, your bank statements, and again, your credit, assets, debts, and cash to close. And most importantly, what mortgage payment are you seeking? Then together, we choose the path that fits the real file. Not the loudest promise, not the fastest answer, but the real life. A bank decline may mean the wrong path was chosen, not that you're an impossible buyer. Your income is real, but the document path can make it look smaller. And that is why we compare the file before applying. So before you apply, review all four paths. Get the data, compare the options, and build the strategy. Data, not hype. And comment options if you want your file reviewed before applying.